Hi, I think we need to start shifting our terminology on the cycle. I don't think we're in a recovery anymore. I think we're in an expansion. It might sound a bit early to be talking about changes in terminology, but I think it's actually quite important. Why do I say expansion? Look, GDP in most of Asia finished last year back above pre-pandemic levels, also in New Zealand. In other countries like Australia and the US, we'll see that this year. And increasingly, estimates of even the lagging countries are being brought forward. Unemployment's fallen very sharply in China for a couple of months now. It's been back at pre-pandemic levels. In the US, unemployment has retraced about 3/4 of the pandemic rise. And in Australia, ANZ Job Ads is suggesting unemployment will continue to fall quite rapidly for a few months yet, even if the end of policy, some policy measures means there's a bit of a hiccup at some point. And also important, I think, is the fact we're at a bit of an inflection point around monetary easing. We seem to be have hit peak easing. China has been winding back gradually for quite a few months. New Zealand's introduced some controls on the housing market. India has tightened cash reserve requirements, and in Australia also there have been some shifts in the portfolio of monetary policy easing measures that have been delivered. To cement this shift from recovery to expansion, I think a few things still need to happen, but I suspect we'll see them. Vaccine rollouts need to continue. They need to continue to be effective, and certainly the news we've seen out of Israel in recent days, where there's data suggesting about 95% success in preventing transmission of COVID, is very, very good news. And we need the hard numbers to validate what we're seeing out of the surveys. As I say, I suspect we'll see that, but I think to really cement this shift, we need to see those things come through. Recovery to expansion, it's not just a semantic issue. What does it mean? A few things. The increase in bond yields, which should continue, are increasingly likely to occur because of increases in the real component rather than the inflation component. The inflation component in the US bond market is now meaningfully above 2%, which is consistent with Fed policy. That looks quite mature. We're likely to see the US dollar be less linearly weak. A cyclical recovery typically is good for high beta currencies, but the increase in US bond yields, I think, changes the dynamic around there, introduces a bit more volatility, actually, as in fact we've already seen. Fiscal policy in many countries should increasingly shift from kind of a pandemic response approach to thinking about what's required for the economy in a longer term sense. I suspect you'll see much more in some countries, investment and less tax breaks and expenditure from the fiscal side. And also, I think lastly, from the business sector, the light at the end of the tunnel is clearly becoming closer. More confidence around vaccines. The shift to expansion is likely to mean businesses increasingly focus on investment and capacity constraints, which are starting to emerge. Certainly, I do think the inflation signals that bond markets have been pricing in the last 6 months are likely to be ultimately validated by the data. Maybe the last point is this COVID crisis in large part should be transitory. This was not a shock driven by some unsustainability in the economy as we would normally understand it. That means as vaccines roll out and economies return closer to normal modes of operation, the sort of policy settings we've seen during COVID, they're not going to be appropriate in the recovery. In fact, they're going to be too stimulatory. We're already seeing those signs in a number of countries. Thank you.